Welcome, curious minds, to Market Brain. Today, we're diving into the very heart of market anxiety, the VIX. Often dubbed the fear index, it measures the market's expectation of future volatility. But here's the twist: the VIX itself is volatile. It moves, it jumps, it makes investors sweat. So, what happens when you want to bet on how that fear index will behave? That's where things get truly wild. The VIX, derived from S&P 500 options prices, gives us a real-time pulse on expected market turbulence. When it spikes, it signals heightened uncertainty; when it dips, relative calm. Today, for instance, the VIX showed significant movement, reminding us that even the measure of fear isn't static. But for sophisticated traders, the real game is in VIX derivatives, options and futures whose value depends on the VIX itself. Pricing these is like trying to predict the weather, when the weather forecast itself is constantly changing. The core challenge? Volatility isn't a constant. It's a dynamic, ever-shifting beast. Traditional models often assume volatility is fixed, which is about as useful as assuming the ocean is always flat. For VIX derivatives, we need models that acknowledge volatility's own volatility, a concept we affectionately call vol of volume. This is where the standard Black-Scholes model throws its hands up in despair. Enter the Bergomi models. These are a class of stochastic volatility models, meaning they treat volatility not as a fixed number, but as a random process that evolves over time. Think of it like this: instead of saying the market's mood is always a 7 out of 10, a stochastic model says the market's mood is currently a 7, but it could swing to a 3 or a 9 based on its own internal dynamics. It's a far more realistic portrayal of financial markets. Mathematically, a stochastic volatility model often describes the instantaneous variance, $V_T$, as following its own random path. A simplified representation might look something like this: $dV_T equals \alpha V_0 V_T dt plus \ETA\SQRT V_T dW_T$. Here, $V_T$ is the variance at time $T$, $\alpha$ is a mean reversion rate pulling variance back to a long-term level $V_0, $ETA$ is the volatility of volatility parameter, and $dW_T$ is a Wiener process representing random shocks. This equation captures the dynamic dance of market uncertainty. Now, Bergomi models come in flavors: one-factor and two-factor. A one-factor model uses a single stochastic process to drive volatility, offering simplicity and speed. But markets are complex. A two-factor model introduces a second, independent stochastic process, allowing it to capture richer, more nuanced volatility dynamics, perhaps a fast-moving component and a slower, more persistent one. This added complexity, while more realistic, traditionally makes pricing and calibration much harder. This is where the genius of quantization steps in. Imagine you have a continuous spectrum of colors, but you only have a limited palette of paints. Quantization is the process of mapping all those continuous colors to the closest color in your limited palette. In finance, it means taking a continuous, complex stochastic process and approximating it with a finite, discrete set of representative states or points. It's like simplifying an infinitely detailed map into a subway diagram. You lose some detail, but gain immense clarity and computational efficiency. More formally, vector quantization aims to find a finite set of centroids or codebook vectors that best represent a given set of data points. For any input vector $x$ from a continuous space, the quantization function $q, x, maps it to the closest centroid $c$ from the codebook $c$. This is often expressed as $q, x, equals \arg_min_ c \n c, x, c $. By doing this, the infinite possibilities of a continuous process are reduced to a manageable, finite number of scenarios, making calculations tractable. The paper we're discussing applies vector quantization within these mixed Bergomi models. The payoff? Speed and efficiency. By discretizing the continuous volatility processes, they can price VIX options and futures much faster. This isn't just an academic exercise; it means quants can calibrate these complex models to real-time market data, like VIX futures and options, over daily data spanning months. This allows for continuous assessment of model accuracy and parameter stability, which is crucial for real-world trading. The results are impressive. Both one- and two-factor mixed Bergomi models, when combined with quantization, show excellent performance in fitting VIX derivatives. Even better, their calibrated parameters demonstrate satisfactory stability over time. This means these sophisticated mathematical tools aren't just theoretical constructs; they are robust, practical instruments for understanding and navigating the complex, volatile world of market fear. So, the next time the VIX starts to jump, remember the quants, armed with Bergomi models and quantization, are trying to predict the fear of that fear.